Well, good afternoon, everybody. Welcome to our quarterly webinar series. My name is Brian Manier. I'm one of the managing partners here at Keystone Financial Group. So glad that you took some time today to listen in and hear about the subject matter that we're going to be discussing this afternoon, which is long-term care. And what we find a lot of times is long-term care is one of those subject matters that people just love to avoid. It's a difficult subject matter. It can be expensive to plan for. And just like anything that's difficult, a lot of times what we see are people just put it off. But what we find is it's such an important subject matter that really needs to be addressed as part of your overall retirement plan, financial plan, whatever you want to call it, because it's one of those things in life that can be either detrimental or it can be life altering to not only yourself, but also your family. And so what we want to talk about this for the next half hour or so and just discuss what are things that you need to look out for. What is some of the data that shows how it can impact either yourself or family members? Just want to make sure that you put together a really good plan because of what it can mean to your overall future. And so what we're going to look at today is a few different things. Number one, we're going to look at planning ahead. What does that mean? How do you go about doing it? What's the best way for you to put a plan in place? We want to address what is long-term care? What is the definition of it? What are things that are covered by different types of insurance plans that are out there? What are the costs that are out there? What are some of the options for paying for care? And then we want to give you an example of a flexible long-term care insurance option and what that could mean for your overall plan. So when we look at long-term care, you first have to look at, okay, how do you envision retirement? If you're in retirement, what are you doing in retirement right now? What are some goals that you have in retirement? Or if you're preparing for retirement, what are some of those financial objectives that you need to meet in order for you to successfully retire? As you look at those, not only the financial goals, but what are some of the personal goals that you have? Maybe that could be, I want to travel. I want to make sure that I can help my grandkids pay for college, or I want to be able to attend their ball games. What we know are people are living much longer now than they did. So if you even think of your own parents, for example, if you're retirement age and your parents are no longer living, more than likely you've probably lived longer than your parents did. And you can see that from generation to generation. What we see is planning for the unexpected is so important, but that's the thing that a lot of people don't plan for. And specifically, that entails medical. What we find a lot of times when you're looking in retirement, you can plan for expenses, you can plan for travel, you can plan for entertainment, but a lot of times the medical piece is really difficult to plan, and that's the biggest unexpected, whether it's just an unexpected illness or an injury or specific to long-term care. So what we see a lot of times is the numbers show that more people have health risks than maybe you have an awareness of. The data shows that 1 in 5 Americans right now are caring for a loved one. Maybe you know somebody, maybe you in particular. I have people that we work with here at Keystone that are caring for elderly parents. And so what we see is 20% of those people that are out there are caring for a loved one. More than 6 million Americans are living with Alzheimer's disease. Think about that stat for a second. How many that is? You probably know people. Maybe you have parents that are struggling with this, going through this. That's a big number, and that's something to keep in mind when planning for yourself for long-term care. Is that something that runs in your family? And then 69% of adults will need some care, some sort of long-term care. And so that's a pretty big number when you think about the different types of long-term care long-term care needs that are out there. More than half are going to need some sort of long-term care. That's important to understand as you plan for what that means specifically for you. So what is long-term care? Well, long-term care is defined specifically as the need for assistance or supervision with the activities of daily living. Now, here are what they call activities of daily living, the ADLs. Eating, being able to eat on your own, being able to bathe on your own, whether that's taking a bath or taking a shower. Toileting, being able to use the toilet in a way that you can do that by yourself. Transferring, whether that's to a bed, whether that's to a chair, doing that on your own, being able to dress on your own, and then continence. And the way that continence is defined is being able to control your bowels or bladder in a way. And if you can't do that, then being able to have a personal hygiene would meet the definition of continence. And then cognitive impairment, meaning do you have the ability to remember, being able to do these things where you're not putting either yourself or others in any sort of harm. And so if you're unable to meet two of these, then you would meet the definition of a long-term care or having long-term care coverage and being able to provide that type of care where two of those, you're unable to perform two of those things. So how do you make a long-term care plan? What does that mean? What we see a lot of times, people avoid really trying to determine what type of care you want to receive, who do you want that care from, and where do you want to live? So what type of care? There are facilities out there right now that have what I would call a progression plan, meaning you start in an independent living facility. Over time, having a plan knowing that if my memory is going to go bad, I can start in an independent facility and I can move into a place where I'm going to have memory care. Is that something that would make sense for you? What type of care do you want? Who do you want to care for you? So is that a family member? Is that a nurse? Everybody's going to have a different decision or a different want when it comes to that. If you have a family member care for you, there are a lot of variables that come into play. Who in your family? What do you want that family to do? Is there some sort of dignity that you want to maintain so you don't want to have a family member? This is a really important decision that you need to start planning for before it's too late, because when it gets to the place where you haven't made those plans and now you need that care, it could be too late to put that plan into place, which you really wouldn't have wanted prior to the time where that care needs to take place. And then where do you want to live? Some people always want to live at their home, regardless of where they're at, what kind of care they need. Is it a home care where you have a nurse or someone come in at your home, or do you want to go to a facility that can care for you? And this type of planning needs to be done well before that need arises. And again, it's a very difficult discussion. It takes a lot of thought. You have to involve your family and people that care about you. But these are questions that need to be answered well before that time where the need arises. And so having to ask yourself, are you prepared, is really important. And part of that preparation is knowing the costs involved. So when you think about costs and you think about having a home health aide, well, what we see here currently, last year, it was $29.51 an hour to do that. And the projected cost of that in 2036 is going to be a little over $44 an hour. If you are going to live at a assisted living facility, the annual cost right now is $54,000. The anticipated cost is going to be over $81,000. And then if you look at the annual cost of a nursing home, if you wanted a private room, that is going to be over $112,000. And so when you think about that in over a decade, what that means is that cost could be well over $170,000 annually for you to live in a private room in a nursing home. So when you think about what that means specifically to your retirement plan, and you can do the quick math of what you have saved in retirement right now, what does that mean for you by pulling those resources out in order to sustain living in some sort of a private room? And specifically, if you're married and you need to go into a home, what does that mean for your spouse in addition to you having this type of needed care? So what are ways that you can pay for this care that you will maybe need in the future? Well, one, you can self-fund it. You can just pull that directly from your retirement assets. We have people that we work with that their plan is to self-fund any long-term care needs that they have. But you still have to have a plan even within the retirement plans that you have set forth just for retirement. The second option is you could have family care for you. This can be good for some people. This can also create some different obstacles for others. You could say, I don't really care. I'm going to spend everything down and I'm going to let the government take care of any needs that I have if I have to go into some sort of facility or I need those long-term care needs. Or you can buy insurance in different ways that can pay for those long-term care needs. Let's talk about those different options and the pros and cons. So what about self-funding? For some people that don't want to buy a separate policy or a separate plan for long-term care needs, they will specifically decide to self-fund that. So some of the advantages of that are you can maintain control of any assets that you have. You can pull that from any of the sources that you have saved. You can do that however you see fit, and then you can determine the type of care or have family help determine that. You can choose wherever you want to go as long as you're able to maintain being able to pay for that by self-funding it. The disadvantages of doing that are the trade-offs, or you may have tax consequences by doing that. So what do I mean by that? Well, most people that we work with or that we come in contact with have retirement sources in the form of either 401ks or IRAs. Every time that you take a distribution from that IRA or that 401k, you have to pay the taxes on that distribution. So if you need to take a distribution and the majority of your assets are in the form of some sort of pre-tax funding vehicle, then you're going to have to pay taxes on that distribution before you can self-fund or make the payment for whatever care you need. It's going to be an impact on your savings and specifically on your spouse. What we find a lot of times when we are planning and helping people plan, or they have already created a plan, most of the time, long-term care is not part of that plan. So you just saw the data on how expensive it is to live in some sort of a nursing facility. If that is not part of your plan when you have originated that plan or put that plan together, and now you have this extra expense, and you are married and your spouse is not in that sort of a facility with you, then it's going to be difficult to now create a new plan, which in a lot of ways is going to cause the likelihood of running out of money in your retirement assets to be more likely. So understanding what self-funding means for you and the additional stresses that can create specifically on a spouse that doesn't have those same sort of needs is going to be important to understand what that looks like for you long term. What about relying on loved ones to care for you? Well, the pros to that is you may get a personalized care. Someone that loves you may give you more attention than someone that you hire. It could be affordable. I have someone in particular who is someone that we work with here at Keystone that is caring for her mother. And she gives an additional attention that maybe somebody wouldn't. She's also not charging her mother or her mother's estate. And if it is, it's a very minimal cost. So in some regards, this can be more affordable than going into a professional or hiring a professional or some sort of facility. The trade-offs are, what is the availability and the location? So if you're planning on your child or your spouse to do this, in order for this to work, the proximity of where you live, even the skill set of that person to care for you is going to have an impact on the type of care that you get. What about the willingness of your family members to be able to do that? And then a lot of times what people don't talk about are the financial and emotional impact on the caregivers. One of the things that you need to have an honest discussion with is if you haven't made plans for long-term care, and maybe you don't have the resources to put a long-term care plan into effect, is what does that mean on your family that's going to care for you? You're doing it because it's more of an affordable option. Well, what we find a lot of times is there's a dignity piece that's involved that a lot of people don't talk about. So, for example, if you have your children care for you in a time of your life when maybe you're forgetting, you have memory issues, maybe you can't do the things that you used to be able to do, how do you want your family to remember you is a question that you have to ask when determining what type of care that you need. A lot of times I've heard people will say, well, you know what, I'm not going to really worry about it. If I get to that point, whatever happens, happens. And sometimes that's unfair for the family members that are caring for you because of obligations that your family already has. Now they have to set aside their obligations to care for you. And it puts them in a place where they're remembering you not as you were, but as you are now. And that can be a very difficult time in their life, and it can create emotional impact or stress that you were hoping you wouldn't have had to go through. So these are considerations when having family members care for you. Some people will say, I'm just going to spend everything down, and then whatever happens, I'm just going to let the government take care of me at that point in time. It's important to understand what that means in the different programs and the different coverages that the programs are going to provide for you. So if you start with Medicare, Medicare is only going to cover short-term nursing, home care, or rehab, and this is after a hospital stay. Now, it does include skilled care in a nursing facility, but it's important to also understand there's no coverage for care in the home or help with personal care needs. So Medicare is not going to cover those things. And after 100 days, the coverage is no longer going to take place. So again, this is only a short term. What about Medicaid? Well, Medicaid is only going to provide coverage when you spend down assets at whatever state that you live in. So for example, if you are married and you go into a facility, Medicaid may allow your surviving spouse to have a home, maybe a vehicle, and just a very minimal amount of assets, liquid assets, before they're even going to provide coverage for you living in a facility or receiving that home care. And so the majority of that income towards the care is only going to be provided after most everything is spent down or exhausted. And so if you don't have a surviving spouse, then everything that you have has to be either spent or exhausted before Medicaid is going to provide coverage. That is important to understand for estate planning. So for example, let's say that you have a beach home somewhere or a lake home somewhere that you want to maintain in your family. Well, Medicaid is not going to provide that coverage while that home is still a listed asset. So it's really important to understand what you have and how these particular government programs are going to provide coverage depending on the assets that you have. So this may be an option for some, but it also may be a wake-up call for some other people to understand that, oh, I'm not going to be able to provide some sort of a legacy to my family and allow Medicaid to pick up the bill for nursing care that you may need. So understanding that is really important. So what about if you use insurance to pay for long-term care? There's different types of insurance that are out there. The first is just a traditional long-term care insurance. And what we have seen with these type of carriers is a lot of these either aren't in existence anymore, or they've had to change the way they do business in order to maintain being able to provide these type of benefits. So historically, what we have seen are policies, they can be customized, and typically they can even have provided some sort of joint coverage options. Premiums over time, what we have seen have been expensive, and what we've seen is the premiums are not guaranteed. So what you've seen, if you have a traditional long-term care policy, is that you have started paying a certain premium, and then over time what you have seen is the cost of those premiums have increased. And so if you have bought this type of policy in your late 50s, early 60s, you're in your 70s or earlier, even early 80s, you have seen the cost of these premiums increase significantly over that time period. What's also true with these policies is you either use it or lose it. Now, that doesn't necessarily mean that is bad. It's kind of like homeowners insurance where you hope you don't use it, but it's an important coverage to have in the event that something catastrophic happens. This is very similar to a traditional long-term care policy. If you don't use it and you pay those premiums over a 10, 15, 20, 25-year period and you never use that policy, those premiums have gone to the insurance carrier and you have nothing to show. Again, doesn't mean it's bad, but that is, you have to understand that is the type of benefit that you are receiving. And as I mentioned before, many of these companies are no longer offering the traditional long-term care option. And the reason for that is that model, unfortunately, just doesn't work. It's not sustainable because of the cost of what we're seeing with typical long-term care coverage and benefits. Where the industry has going now is more so to a hybrid life insurance long-term care benefit. Specifically, we see this true with whole life insurance contracts. Now, what we're seeing is you can build the long-term care benefits specifically into a life insurance contract. And what we're seeing specifically are guaranteed premiums that you can either purchase over a one-time, a 10-year period. You can see this over a lifetime where you can pay those premiums over your entire life. And the way that that is determined is by determining what kind of long-term care benefit that you need. So for example, if you said, I want to have coverage for a long-term care policy that's going to provide $8,000 a month, you can determine what that looks like. The insurance carrier will determine what the premiums are going to be based on how often, whether that's monthly, whether that's annual, whether that's over a 10-year period. And those premiums will be determined based on that benefit and based on that timeline. And so initially, what we see with these policies, it would be more expensive than a traditional long-term care policy, but the benefit is that the premiums are guaranteed and they're set, and you never have to worry about the cost of those premiums increasing as you're paying into this, whether it's the course of your life or whether it's a time period that you have set. Everything has its pluses, everything has its trade-offs, but this is the way that the industry is starting to shift into these hybrid life long-term care benefits. Now, when you look into long-term care coverage, there is an approval period that the carrier has to look at before they issue that policy. And so here are the approval rates for long-term care coverages. And just like anything, it's going to decrease with approval rates over time with increases in age. So if you're looking and you're under 50 and you're looking to get some sort of a long-term care policy, there's an 80% chance that you're going to be approved. Between 50 and 59, that goes down a little bit, not significantly, but there's a 78, still almost 80% chance that you're going to get an approval rate from the carrier. And then you can see as you get older what that looks like. Now, most of the time, people really start to think about this in their late 60s, early 70s, when they're starting to either have memory issues or they're starting to have health issues. And then this is the time when people start to really consider, do I need a long-term care plan? A lot of times when you get to 70, and I have seen this even with current clients, is those costs can be really significant when trying to buy some sort of long-term care coverage. And you're just over a 50% approval rate at that point in time. And so the point of when you see this data, the thing that should trigger is now I have to really start to consider putting in a plan even before you get into retirement age. This should really be a part of the retirement plan as you are preparing for retirement, not necessarily when you get into retirement. And even if you want to get coverage for long-term care, you're not guaranteed coverage. Specifically, you see that as you start to get older. So really important information to consider when putting together the plan. So why is having the plan so important? Well, when you look at a pie chart and you look at this specifically as some sort of sample portfolio as you start to plan for retirement, you're going to look at things like I have investments and retirement savings and whatever that plan is created. What are my tangible assets that I have, like my home, like my car? If I have a vacation spot or I inherited a lake house somewhere, those are tangible assets. What about my liquid assets that I'm spending down in the short term? And maybe I even have some life insurance, whether that's a term or a UL, or maybe I have some cash value life insurance. Well, if you've worked with us or you're working with a planner, a good planner is going to understand, well, what are the expenses that you have in retirement? How are you planning for those living expenses? Well, now you have this additional expense with the potential long-term care expense that you may have not even considered. And as the income that you have from sources like whether you're working part-time, whether that's Social Security, whether that's pension, whatever that is, how are you planning for those expenses? Well, by having a long-term care plan, specifically by utilizing maybe even a long-term care policy, that may be able to offset some of those expenses. And if you have a plan in place and you implement one of these policies even before you specifically retire, that's going to help you plan for it, offset some of those costs that you may get when those long-term care expenses arise. So how do you leverage that? If you're going to just self-fund it, think about it, it's a one-to-one. So if you're going to move into a facility or you're going to have home care, maybe that's $8,000 a month. You have to pull that $8,000 a month from whatever retirement plan that you have set aside. And when you start to figure out the math and you start to actually put that plan in place or plan for that, you're going to see that's going to drain those assets that you have very quickly. And if you're married, you have to understand what that is going to do to potentially your spouse that doesn't need the same long-term care that maybe you need. When you have a plan in place, you're going to see that the dollar, it's not a one-to-one. You're going to have coverage that's going to offset some of those expenses. So there are guaranteed protection for these type of planning needs. And so what you're going to have to understand is if you need care, you're going to receive cash. It's going to provide a cash indemnity benefit that you can deem and choose however you need that within the confines of the plan. The other thing about these hybrid plans is that when you pass away, your beneficiaries are now going to receive a guaranteed tax-free death benefit that you even didn't have under the terms of the typical long-term care policy. So this could be an added benefit. It could even be part of the legacy plan. If you want money back, you can surrender your policy and get some of the cash on hand. It may not be the best investment, but if you are desperate and you need that, there is a cash value to some of these hybrid plans. And if you want to stop paying your premiums, you can still get a policy with a smaller benefit pool based on the money that you've already put in. So what this means is when you pick one of these hybrid plans is you have some options that you didn't have with either the typical long-term care policy or if you choose to just self-fund it. So some of the long-term care benefits under these hybrid plans consists of things like adult daycare, assisted living, bed reservation, caregiving training. There's some home health care options that you may have, some home modification, household services, specifically if you want to live in your house and have home care directly for you, informal care, skilled nursing home care, respite care, and then benefits even outside the U.S. So these are things to consider when looking at a hybrid plan and some of the things that may be important to you. Now, the other thing to look at is when choosing a plan, the difference between what reimbursement looks like and having cash indemnity. And so as you see here on your screen, looking at the different eligibility requirements is that you are certified as chronically ill by a licensed healthcare professional. So that's the first step or the first criteria that you have to go through. And then having a plan care
plan of care and satisfied your policy's elimination period. So you have to get through those requirements. But then looking at the differences between what does it mean to get reimbursed and what does it mean to have cash indemnity. So for example, your monthly long-term care benefit, from a reimbursement standpoint, that's limited to an actual expense incurred that are covered by the policy, and you can't exceed that monthly maximum. The cash indemnity plan means up to 100% of the monthly maximum is paid as a cash benefit. On the reimbursement side, when it comes to monthly bills, you have to have those receipts. Those are required. The cash indemnity, they may not be required. For informal care, from a reimbursement standpoint, it's limited or there's no coverage for unlicensed informal caregivers. From a cash indemnity side, it's a little bit different. On the restrictions on use of benefits, the reimbursement, there are restrictions but you can only use, qualified care expenses as defined in the contract, whereas the cash indemnity side, you don't have those same restrictions. So understanding the differences as you start to think about if you want some sort of a hybrid plan, those are things that we would go over to make sure that you understand the differences between the reimbursement and the cash indemnity and making sure that it fits your specific needs. So when you're looking at planning, what we want to encourage you today is the initial conversation of what does long-term care look like for you? How do you fund it? And how do you want to go about your specific plan? Whether that's a licensed professional, whether that's a family member, whether that's in-home, whether that's in a facility. So starting to prepare what may lie ahead can at least give you some confidence of knowing how you're going to plan for it, knowing the different options, specifically with some of these hybrid plans that are out there that can provide some flexibility, and knowing that you can customize an approach that specifically works for you. So if this is something that you feel like you need to have this conversation, if you're already working with us, you know Rose, call Rose, email Rose, and she'll put time on your advisor's calendar to have this discussion. If you're not already working with us, and this is something that you feel like you need to have this discussion, we would welcome you, encourage you to get a hold of Rose. Her number and her email is on the screen. Reach out to her. She'll be happy to create some time with one of us here at Keystone, and we'll be happy to have that initial conversation with you. As always, appreciate your time, appreciate you taking some time to talk and hear about this important subject matter, whether it's this or anything else as it comes to your holistic plan. We would love to continue any conversations that you would have or welcome anything new or just talk about any questions that you have. Thank you so much for your time. Looking forward to talking to you or meeting with you in the near future. Enjoy the rest of your week.